great pleasure to present my work in this for this crowd. And so the paper here is one of the recent research agenda on my list. So I have always been very interested in understanding people's preferences, right? Whether it's top management's preference or employees' preference, investors' preference. So, and also we know that in recent years there is this, has been increasing attention to people's non-financial preferences, right? What I mean by non-financial preferences, that means it's outside the main traditional preferences that we care a lot in finance, such as risk preference and time preference. Okay, so I think that, a lot of studies have started to show that other preferences, right, of investors, of employees, of management start to have real impact on our decision-making. So this paper is about political preferences. Okay, so we start with this observation that, it seems that we have increasing political divide outside the traditional political realm, right? So political preferences seems to affect an increasing number of decisions, such as, whether to wear a mask during the pandemic, right? With what clothes to wear. We have red jeans and blue jeans, okay, and what cars to drive, and more importantly, where to live. Okay, so then we wonder, right? Wow, if political preferences are affecting such a wide range of decisions, could actually it also affect households' demand for financial assets? Okay, such as which stocks to hold or not to hold. So in this study, we examined the differences in equity portfolios of households in different U.S. counties with different political preferences, okay, over a long horizon over the past 25 years. So this graph shows that, if we pick any county pair, right, A and B, we can measure how different their political preferences are. If we observe the household portfolios, equity portfolios, we can also measure how different the equity portfolios are. Right, and then in this study, we asked, are these two related? Okay, and does political distance of a county pair lead to portfolio distance of the county pair? Right, and if the answer is yes, then what are the potential mechanisms? And so in this study, we're gonna look at two specific mechanisms, right? Political shaped economic expectations. That means that because we have different political views, right, this may shape our beliefs about future economy, right, the condition of future economy. And this could also be, macro expectations. It could also be industry-specific expectations related to policies. And then the second channel is the politically shaped values, right? So it's not about economic expectations, but it's about what we believe in life. Right, and this could include politically shaped environmental preferences, social preferences, right? Politically shaped views on a range of things that in our lives. So we're gonna try to these two are not mutually exclusive, but we will try to distinguish between them. So we want to have a simple illustrative model to help us kind of organize our thoughts. And so we assume that there are three types of investors, right? There's democratic leaning, this is in the US setting, right? So we have a two-party system here. So we have democratic leaning investors, Republican leaning investors, and the independent or politically neutral in the two-party system. And for any pair of counties, A and B, we define political distance as the sum of the absolute differences in investors' political preferences, right? So we have three types of investors, and then we have three absolute differences, and we sum them up. And we define portfolio distance in a similar way, right? It's the sum of absolute differences in the equity portfolio weights between the two counties, right? So for any stock I in county A, the weight, right, on the stock is the weighted average across the 3 types of investors in this county. Okay, and then we compare, right, the stock I's weight in A and stock I's weight in B, right, and then we sum up the absolute differences across the stocks held by A and B. And then we're going to make 2 simple assumptions. Okay, the first one is that we assume that independent investors, their portfolio weights are not influenced by political preferences, right? It's kind of like we can think of like market weights or anything that's not influenced by political preferences. But Democratic and Republican investors, they could tilt their portfolio weights because of their political preferences, right? So we can have the delta N rho here as the possible tilt. And then we assume that the fraction of independent investors is approximately the same in both counties. So this is really just to simplify the mathematical expressions. It's not crucial. So then we get a nice kind of simple expression of the relationship between portfolio distance and political distance. Okay, portfolio distance is actually proportional to the political distance between the 2 counties. And the proportional factor is the weighted average partisan portfolio disagreement across all the stocks held by A and B, right? So this is the political tilts on stock I, and then we basically do a weighted average. So portfolio distance equals to political distance times this average partisan portfolio disagreement. If we run a regression, then this beta 1 coefficient could capture the empirical partisan portfolio disagreement, right? So this is why our empirical analysis is guided by this simple framework, because this shows that if we do this kind of regression, we can observe the average partisan portfolio disagreement. So now on the empirical measure of political difference, so our main measure is based on the U.S. presidential election voting shares, right? For each county, we observe the fraction of voters for Democratic candidates, Republican candidates, and independent candidates. And an alternative measure is based on the survey, right? Self-reported political preferences of high-income individuals in a county. So here we only focus on high-income individuals because we believe that they are more likely to be the financial investors that we are interested in. Okay. So this is the county pair political distance based on the election voting result, and we can see that over the past 25 years, county pair political distance has increased by 40%. So that means that if we pick any 2 counties, their political views, political preferences have become increasingly different over the past 25 years. So now get to the portfolio side. So we start with the observation that wealthy households often work with local wealth managers. So we want to identify local independent investment advisors that mainly serve individuals rather than institutions. Okay, so and the information is going to come from this form ADV data, because this is a form that all investment advisors need to file with the Securities Exchange Commission, and the form lists the type of clients and the number and location of offices, which can help us identify local, right, and also whether the client base is mainly individual. And then the portfolio holdings of these individuals, okay, will be reviewed in the 13F holdings data that institutional investors need to file with the SEC. Okay, so we are going to look at we're going to select advisors for whom individual clients account for at least 50% of the client base, right, and the office locations in only 1 MSA. Right, this is to capture the local nature and also the individual, the retail nature. And then we merge with their certain F holding data, and we want to observe at least 50% of the total assets under management for the advisor, just to kind of make sure that we get the bulk part of the wealth managed by the advisor. So this gives us over 1,600 unique advisors in 309 US counties, right? And then the total equity portfolio of this group of advisors on average accounted for 3.2% of the US equity market. So is this big or small? Actually, it's much bigger than the equity portfolios analyzed in prior household finance papers, right? And then there's also a recent study, which is also has amazing data of the equity portfolios values of millions of households in the United States. And so in our sample, our total equity portfolio was about close to 1 trillion in 2019. So it's actually pretty comparable to the study of Neowis et al., which actually has millions of households. We don't have millions of households, but I will show you that our households tend to be much wealthier than the households in their study. Okay, so we actually think that the certain F holding data of local retail advisors are actually a reasonable source of U.S. household portfolio data. And also the advantage here is that we can have a long time series, right? All the other detailed household portfolio data often come with a very short time series. So we think that this is, in terms of the data, we think that this could be a valuable data source. And then, so now here, what kind of advisors end up in our sample? So for the advisors in our sample, we can see that individual client share is 93%. By investor count, and then 81% in terms of assets under management. So we are successful at identifying advisors that mainly cater to individual clients. And then these advisors, they manage a moderate number of accounts, but each account tends to be large, right? So the average AUM per account is close to 5 million. So this shows that it is, the households in our sample tend to be much wealthier than the average household, right? And then for comparison purposes, right? So there is Edward Jones, which is a national retail advisor. So therefore not in our sample, right? We want to capture local retail advisor. So this national retail advisor has a lot more accounts, but with much, each account is much smaller. So as I just mentioned, that our sample tends to include wealthy households. Okay, this is certainly not a random sample, right? It's also not representative of the average household in the U.S., but we want to argue that they are a very meaningful sample to examine, because these wealthy households, they are certainly important financial investors, right? They are always in the market based on their investable wealth. Okay, and also they tend to be the understudied group of investors, because most of the households portfolio analysis, okay, are based on surveys of households. Okay, and those surveys generally routinely miss the upper part of the wealth distribution, right? They usually don't include the really wealthy households. So this is why I think that our approach allow us to look into this group of households and their equity portfolios, and also other portfolio choices. Okay, so we and then also another thing is that we only focus on out-of-state equities. Okay, so for County A, we look at the household's equity holdings outside, direct equity holdings outside the state, right, of County A. And this is because we don't want to actually have the local bias influence our result, right? So of course, actually, two counties could have different portfolios, only simply just because of local bias, which it has been well documented in the literature. So that's why we only focus on out-of-state equities, and which actually accounts for 80% of the equity holdings. So we can see that each county in our sample, we have a full sample of 309 counties, and we also consider a balanced sample of 94 counties they're always in our sample. right? Because counties could come and go based on, sort of whether they have the advisors we look for. So we can see that for the county in our sample, they on average, the households on average hold about 100 stocks and over 120 stocks, and then 100 of them tend to be the out-of-state stocks. So now this is the portfolio distance, right? The sum of the absolute differences across on the stocks weights, portfolio weights across stocks. So, and interesting, we can see that over the past 25 years, the portfolio distance actually has been decreasing, which suggests that if we take any pair of counties and look at their wealthy households' equity portfolios, they are becoming more similar over time. Okay, so now this figure is summarizes our baseline baseline findings. So here we regress portfolio distance on political distance by year, right? Because we really want to understand the time trend, and then our long time series data allows us to do so. Okay, so this here we plot the beta coefficient estimate by year. And we can see that for wealthy households in our sample, political tilts on stocks were on average small in the early periods, but they have become increasingly large in recent years. Okay, so if we want to interpret this time series pattern using our illustrative model, this suggests that, okay, either, partisan disagreements on stocks that are always sensitive, politically sensitive, have become larger, right? The disagreement has become larger on these politically sensitive stocks, leading to a larger average partisan portfolio disagreement. Or the number of politically sensitive stocks have increased over time, right? So just kind of like nowadays, it seems that there's increasing number of decisions that become politically sensitive, right? Maybe more and more stocks, okay, they were not used to be politically sensitive, but now they become somehow politically sensitive. This will also drive up the average partisan portfolio disagreement. Okay, so but then anyway, this significant, or we say prevalent, partisan portfolio disagreement is a relatively recent phenomenon in the United States. And just our results are robust to, alternative measures of political distance or portfolio distance. And then also we try to control for potentially omitted county pair differences, right? And we do have county pair fixed effects in the regression, but there could be other time-varying county pair differences that may drive our results, right? So we control for county pair differences in sort of information set, right? Related to geographic location, related to the county's industry composition. We also control for county pair differences in religious preferences, right? Which actually studies have shown that also affects people's portfolio choices. And we also control for county pair differences in the basic demographics, right? Like such as population, income, and education. And then our results are robust to controlling for these other county pair differences. Okay, but of course that we cannot really exhaust all possible county pair differences, right? And so we are gonna explore an exogenous shock to the county pair political distance, right? And we are gonna explore the entry of a conservative TV network called Sinclair Broadcast Group. Okay, I wouldn't be surprised that most of you have never heard of this company. Actually, I have never heard of this company before I conducted this research. Okay. But then I realized that Sinclair is actually the second largest TV network in the United States, right? Covering, over about 40% of the US households. So it's and this actually, the insight comes from the political science literature, right? That literature shows that Sinclair's entry shifts the news contents and to the right, okay, to political right, And therefore, also shifts local political attitudes and presidential election voting shares to the right, and so makes the sort of the county more pro-Republican. And so now a cool feature of Sinclair's entry in our setting is that, since we study county pairs, right? So then the treatment effect really depends on whether Sinclair enters the more Republican county in the pair or not. So if Sinclair enters County B, which is the more Republican county in the pair, and push it more to the right, this is going to increase the political distance between A and B, right? But if Sinclair enters County A, the less Republican county in the pair, then it's going to push this county more to the right and therefore decrease the political distance between A and B. So now, remember that the county pair formation in our study is exogenous. We just form all possible county pairs, right? Therefore, the within pair difference in political preference is exogenously determined. So now this means that the treatment direction, is going to depend, is exogenous, right? Suppose that Sinclair enters County A, right? In this pair, County A is the less Republican one. Therefore, Sinclair is going to lead to have a decrease in the political distance. But in another county pair, A and C, County A may be the more Republican one, and then the same entry event is going to lead to an increase in political distance, And since we form all possible pairs with County A, then A will be basically the same entry event will lead to a positive treatment effect in some county pairs and negative treatment effect in others. And then that is exogenously determined. So this actually gives us a very clean identification setting to study the political distance effect on portfolio distance. So here, this one, I show you that relative to negative treatment county pairs, right? County pairs receive negative treatment. The county pairs that receive positive treatment, experience an increase in portfolio distance after the Sinclair entry, right? So 0 is the year Sinclair enters one of the counties in the pair. So positive treatment leads to an increase in the portfolio distance. So this actually supports a causal interpretation of political distance on portfolio distance. And then this just to show you the regression result, right? We also have a larger sample that includes non-treated county pairs, right? Like Sinclair does not enter any of the counties in the pair, right? So, and then we see a similar result. This here is just within the treated county pairs, right? The kind of the graph I just showed you. So, all right, so now after establishing a causal impact of political distance on portfolio distance, we are gonna just turn to the mechanisms, right? So as I have already mentioned, we're gonna focus on two mechanisms. The first one is politically shaped economic expectations. So expectations about either macroeconomy or industry-specific conditions could differ, by political leaning or political preferences. So, and this actually has been studied in other research, and then we are simply gonna show what is the role of differential economic expectations in explaining our results. And then the next one is differential values and preferences. So we may have noticed that there has been in this dramatic rise in the so-called values-based investing, which promotes the inclusion of personal values in portfolio choices. so basically argues that our financial investments should be aligned with our personal values, right? So I give you some interesting examples from the ETFs. Okay, so because from the title of the ETF, we can clearly see the values that the portfolio tried to cater to, right? So, for example, we have gender diversity ETF, right? And we have vegan climate and or Catholic values ETF, right? So these are all ETFs or financial portfolios that try to, sort of align our financial investments with these values that are indicated by the title. Okay, or if firms or their leaders, okay, are perceived as Republican or Democratic, then political preferences could actually apply directly to the selection of stocks that are, that have colors, right? So blue stocks and red stocks. So here's my favorite example of this, which is this MAGA ETF, right? Make America Great Again. So we can clearly see that this ETF caters to the Republican views, and it only includes stocks that are viewed as Republican stocks. Okay. So now get to the first channel, which is the politically shaped economic expectations. Let's start with macro expectations. Okay, so this is the survey data, and it shows that clearly that Republicans and Democrats, their views about the economic conditions could differ a lot, right, based on who is in the White House, right? And so during the under the Republican presidency, right, then the Republicans generally have a much rosier view about the macro economy. Okay, and this is also not new, right? It's actually this is a well-known. This is survey data, and also I think other studies also show from not just surveys but also from investors' portfolios. So we find that distance in macro expectations matter for portfolio distance, right? If two counties, they have very different views about the macro conditions, they also tend to hold different portfolios. But this difference in macro expectations doesn't seem to explain much of the portfolio political distance effect, right? When we control for the county pair distance in macro expectations, the political distance effect still largely holds. Okay, so now get to the politically shaped values. So I'd like to draw your attention to a very interesting study, okay, by two economists who study the values divide across the common identity groups. Okay, so they actually over the past 30, 40 years. So what they show is that the values divide across along the partisan line has increased substantially in the United States, and particularly in the second half of the 2000s. Okay, but the values divide across other identity lines, such as income, right? High income versus low income, men versus women, right? White versus non-white, and urban versus rural. So the values divide across these other identity lines have been relatively stable or even declining. Okay, well, across the religious line, there's definitely some increase, but not as dramatic as the values divide across the partisan line. Okay, so this suggests that the partisan values divide is a prominent phenomenon in the U.S. society, especially right since the second half of the 2000s. And at the same time, we observe the rise of the so-called values-based investing, which includes ESG investing, but is not limited to that, right? So more and more asset managers can now try to offer the so-called values tilts, okay, and advocate for financial investments that are aligned with our personal values. So if the increasingly large values divide along the partisan line, right, could create demand for values-based investment portfolios, right? To express our values, and especially, to kind of distinguish our values from the values of the opposite group. And at the same time, right, the rising values-based investing provides a supply, right? So we have increasing demand and supply of sort of values-based investing. And so these actually could lead to increasing portfolio difference due to differences in values. Okay. So now we are going to use the environmental protection and labor protection as examples to illustrate that the political views are increasingly different on these issues. Okay, so here it shows that the political gap, which is the difference in Democrats' view and the Republicans' view, we can see that the difference has been increasing over time on these two particular issues, right? That's our example. And we also find that these the increasing political gap on these issues predictably affect households' portfolios on stocks with environmental concerns and stocks with labor concerns in the way consistent with the increasing political gap, right? So here it shows that the Dem share here. This is shows the Democratic leaning of a county, and then as the county, the more Democratic counties, okay, and they have a lower portfolio weight on stocks with environmental concerns or labor concerns, and particularly in recent years, right? In the earlier period, it seems that Democratic leaning doesn't predict portfolio weights on these stocks, while in recent years, Democratic counties started to decrease their holdings in these stocks. But then you say, so, well, this result could also be consistent with basically political shaped beliefs about, especially related to regulatory risk of specific of these stocks, right? Because Democrats, the survey data suggests that Democrats tend to perceive substantially lower regulatory risk under a Republican presidency relative to a Democratic presidency, right? So they believe that the regulatory regulation is gonna be reduced, and therefore regulatory risk is actually gonna decrease. While Republicans actually doesn't think that anything's gonna change when we go from a Democratic president to a Republican president. Okay, so now this actually setting could allow us to distinguish, is this because, okay, Democratic counties think that stocks with environmental concerns or labor concerns tend to be riskier, especially in terms of the regulatory risk, or it's because of their values? They simply just dislike stocks that pose environmental concerns or labor concerns, right? So to differentiate these two, we are gonna utilize this insight from the survey, right? If it's really driven by risk concerns, Democratic investors would hold more stocks with these concerns under a Republican presidency, because they believe that the regulatory risk is gonna be substantially lower under a Republican presidency, okay? But if our results are driven by values, then Democratic investors, right, should hold the same or even less of these problematic stocks under a Republican presidency, right? Because, if the Democratic investors, they may believe that these companies, right, they may impose bigger damage to the environment or to labor, okay, under a Republican presidency when the regulation is lax. So this could lead to even a reduction in the holdings of these stocks. Okay, so we derive opposite predictions under these two hypotheses. Okay, and then here's what we find. And we find that relative to under a Democratic presidency, under Republican presidency, Democratic-leaning counties, right, the households in Democratic-leaning counties actually decrease their holdings of stocks with environmental concerns and labor concerns. Okay, so this is consistent with the values concern, right, the values channel, and inconsistent with the cash flow risk channel due to regulations. Okay, and then here we can see that Republican-leaning counties, they do not really change their portfolios as we go from a Democratic president to a Republican president. Okay, so actually that's both stories, right? Both risk concerns and value concerns will predict that they don't have to do anything, right? Because under the risk concerns, Republicans, they do not believe that regulatory risk will substantially change going from a Democratic president to a Republican president, right? So therefore, there's no reason they're going to change their portfolios based on risk concerns, right? And then values concerns, again, we don't have any prediction, okay, about whether they're going to change or not. So then, but also in addition, that the fact that they do nothing, okay, suggests that the decrease in the portfolio weights in Democratic counties are unlikely driven by a pure price effect, right? Because if, for example, for whatever reason, the stocks with environmental concerns and labor concerns, okay, had depreciate in value under a Republican presidency for whatever reason, right? Then it's going to show up for the Democratic-leaning counties as well, right? As long as you hold the stock, the value effect is going to show up. So the fact that actually it only shows up in Democratic-leaning counties, not Republican ones, suggests that this result is unlikely driven by pure price effects. But we also, in appendix, we also run a sort of this Korean yoga style, like demand system regression. We cannot really do a full-blown sort of a demand system of asset pricing, right? Because we do not have market clearing here. We only observe a small fraction of the equity market. Okay, but we can run a Korean yoga style regression. Okay, and so there we can, we regress the stock weight, right, on all kinds of on the characteristics and the county characteristics, stock characteristics, and fixed effects, and so on. So there we can even more robustly show that what we find is not driven by pure price effects. But I think here we already can see, right, based on the contrasting kind of behaviors of Democratic-leaning and Republican-leaning counties, we can already see that it's unlikely to be a pure price effects. Here we look at the attitudes towards the other party, right? And we find that in the United States, right? So the party members, they increasingly dislike the members of the other party. Okay, and then here we also see that this widening political views of the other party, it also predictably affect, okay, the household portfolios in stocks that are kind of have political colors, right? We find that more Republican counties invest less in stocks of firms run by Democratic-leaning CEOs, and particularly in recent years. So consistent with what we have found before, that the political gap in values predictably affect portfolio difference in portfolio choices. Okay, so last one is related to the role of advisors, right? So this is a natural question, right? Could our findings be driven by the political preferences of advisors rather than those of households that they serve, right? This is a natural question because we study dedicated portfolios, okay? And so it could be that it's just really the advisors running the show rather than, kind of serving the preferences of their clients. Okay, but so far our interpretations would be fine if the political preferences are aligned between advisors and their clients, either because they both live in the same county, right, and therefore they share the local political preference, or because of sorting, right? Clients may want to find advisors with like-minded, views, or it could be that advisors that cater to the preference of clients and often through the client's investment restrictions and mandates, right? So for the advisors in our sample, the ADV form does show that many of them allow clients to put in investment restrictions and mandates, right? Telling us what stocks that you definitely don't want to have or which industries you want to avoid, right? So it suggests that advisors may have incentive to cater to the preferences of their clients. But if the preferences are neither aligned nor catered, so then we may have an agency problem, right? So it's really just advisors' views driving the portfolio choices. So to examine this possibility, we construct a measure of an advisor's political preference using their employees' individual political donation data, right? And so based on what their employees are donating to, right, which party the employees are donating to, we create a measure of advisors' political leaning. Okay, so the Dem share advisor is a fraction of democratic leaning employees among all employees with identifiable political preferences within an advisor. And interestingly, we find that the advisors are more likely to be Republican leaning, while the counties they live in are more likely to be Democratic leaning. Okay, the correlation between the two preferences is 21%. It's positively correlated, but it's actually not that highly correlated, right? At least kind of not as highly correlated as we expected. Okay, so it suggests that well, maybe the preferences are not that aligned. Okay, but advisor could still cater to the preference of their clients. Okay, or they simply run the show. So now next we're gonna relate the advisor's portfolio weights on stocks with environmental concerns or labor concerns on the advisor's political preference. Okay, and we find that the advisor's democratic leaning does not predict the advisor's portfolio weights on stocks with environmental or labor concerns, while the county's portfolio, the political leaning does, right? So this suggests that advisors' political preference is unlikely to drive our results, right? It's so the county level political preference likely capture the client's views rather than the advisor's views. Okay, so and then some of you may know that there are studies that show that mutual fund managers, okay, their portfolio, their political preferences do show up in the portfolio choices, right? Then you say, why actually are advisors in our sample different from the mutual fund managers, right? So we actually think that the difference could lie in the fact that the asset manager client relationship can be very different for advisors in our sample and the mutual fund managers. So note that advisors in our sample, they cater to local wealthy households, right? They serve a relatively small number of clients, but each client is very important, right? So this gives advisors incentive to get to know their clients personally and cater to their preferences, right? This is also why we see that they increasingly allow clients to put in investment restrictions and mandates. While mutual fund managers, they manage money for a large number of anonymous clients, right? Mutual fund managers probably have no idea what their clients' political preferences are, right? And therefore, mutual fund managers' political preferences are more likely to play a bigger role in the portfolios they manage relative to advisors in our sample. Okay, so now I think that I'm ready to conclude, and therefore we can leave enough time for Q&A. Okay, so in this paper, we document this deepening geographic divide in political preferences, okay, leading to increasing geographic divide in households' equity portfolios in the United States. And we really highlight these politically shaped values driving the documented phenomena, right? Driving this relationship between political distance and portfolio distance. So, and then some of you may wonder, what happened? What explains the regime change around 2013, right? I showed you that before 2013, political distance between two counties has been rising, but it doesn't show up in the portfolio distance. But after 2012, then it seems that it increasingly shows up in the portfolio distance. So we don't have I guess a rigorous answer, right? So here's what we believe. We believe that it is more likely an outcome of the continuous development in the demand and supply of values-based investment over time than an outcome of some specific triggering event, right? When we have the regime change, we always wonder, is it due to some specific event? But unfortunately, we don't really, we haven't found a specific triggering event, right? There are patterns that are consistent with our patterns, but doesn't mean that these other patterns are the cause of what we observe, right? So, but we do show that in the periods before 2013, things are brewing, right, related to the demand and supply of values-based investing. Okay, and then things are brewing, and then it could be that a continuous development, okay, in the demand and supply finally leads to a discrete change in the relationship that we observe. Okay, so that's our view. But if you can, have some idea about specific triggering event that we can look into, we're happy to investigate. So and then lastly, right, politically shaped values investing could reduce risk sharing and increase market segmentation and economic differences, right? So what we document could have profound implications for how we should think about the equity markets, right? And it could also pose challenges for firms, okay, that need to consider political positioning relative to their shareholders, right? If shareholders care more and more about aligning their political preferences with that of the firm, okay, then this could pose challenges for the firms. Okay, I think that I'm gonna stop right here.